Welcome to Retire Smart Maryland with Prashant Sabapathi and Nick Innerbichler. I'm your host, Spike Spengel. You try saying that 3 times fast. Gentlemen, how are you doing this week? Prashant,
doing great,
how are you, buddy?
Spike. How are you?
Great, great. Nick, good to see you. Good to see you joining us on the desk.
Thanks, Spike. Good to see you.
I understand that you're going to bring us the heat on market volatility
I'm
right
ready.
now.
I've been in the bullpen.
Right. Yeah, you have been. You've been on the sidelines. So great to have you joining us on the program. Folks, today for your retirement planning, we are going to be talking about market volatility. I'm sure that you're aware of it. I'm sure that you're seeing it on the news. You're getting all of those announcements to your phone. And today we need to address not only the news of it, but what to do about it. And I think that's what you wanted to bring up today, Prashant.
You know, we've had so many people come in the office recently, and they've been telling us, hey, we've lost $50,000, $100,000, $200,000 of their retirement 401ks, IRAs this year. Everyone's a little bit kind of freaked out about what's going on. I know that you had just told me something, an interesting statistic, Nick, about, you know, the traditional 60-40 portfolio. You know, it used to be that you could allocate your portfolio 60% stocks, 40% bonds, but it's been a really interesting year for that 60-40 portfolio, hasn't it?
It sure has, Prashant. It's the worst year we've seen for a 60%, 40% bond allocation since 1936.
Whew. What was happening in 1936?
We were in the Great Depression.
Yeah.
And that's startling to a lot of people because we had the tech bubble, we had the financial crisis, we had what we call the black swan event of COVID, where the market did take off and did really well for the rest of the year. But this has been a little bit startling for people, and we have a lot of different things going on right now. There's not really a lot of places to hide.
Right. So let's break this down slowly, and let's also not try to worry our audience too much. Again, we're going to be providing solutions today. Let's start with the stock market.
Yeah.
What do you think is pushing this down so much? I mean, we've seen, depending on when the show airs, 30% downturns in the market. We don't know where it's going to be by the end of the year. We don't know what's going to happen next year. But like you were saying, I don't think this is the black swan event of 2 years ago. And even the recovery that we had from 2008, I mean, they came back within 3 or 4 years. You could start seeing that to go up. What is pushing our market down, though, so far right now?
So I think the Federal Reserve is a huge part of this, okay? With interest rates starting to go back up, it's created a lot of negative pressure in the market, and that's all because of inflation. I mean, we've all felt it this year, right? You go to the grocery store, you go to the gas pump, everything is costing a heck of a lot more money. And when prices are high and people don't have as much money to spend, it's not good for the stock market. And so we've seen a heck of a lot of market volatility, 20%, 30% down at different points in the year. And that is a scary thing to go through because you've probably been doing the responsible thing that you were taught to do, which is save your money into your 401k, every single paycheck you're putting money in, and to see it decline by tens, if not hundreds of thousands of dollars is a pretty scary thing to go through when you have to depend on that money when you retire. So stock market, it's got to be inflation. We have to see meaningful improvement on inflation before this market stabilizes. And quite frankly, I don't know when that's going to be, Spike.
Jerome Powell, we keep hearing him say, we've got to continue to bring the pain if we want to bring inflation down. The pain, though, Nick, I'm seeing it regular American households, our retirees. It's the retirees who feel inflation the most because they're on a relatively fixed income, correct?
That's the hardest part. You know, you want to retire and you want to be successful. You don't want to have to go back to work. And the great thing about what we do, I was meeting with a couple of longtime clients recently, and, you know, they're asking me, am I okay? And they've been retired for many years. And, you know, the good news is that they followed the Retire Smart roadmap. We put that together for them back in the beginning, many years ago. And the fact that they have money invested many different ways, they're not feeling the pain so much that other Americans might be feeling right now. So if you put together that Retire Smart roadmap, you have a plan for where you're going in retirement. It doesn't have to change.
And for folks who are watching this program right now, I just want to ask, at the beginning of the show, is it too late for somebody who has been feeling the pain? Like you were saying before, there are folks out there who have lost $50,000, $100,000, even more in their retirement accounts. Is it too late to make a change if they didn't have a Retire Smart roadmap before?
Yeah, look, I don't think it's ever too late to get started and to really look at this type of thing, because who knows where the bottom is, right? If you've lost $50,000 or $100,000 this year, who's to say that that loss won't go to $150,000 or $200,000? And so why not be proactive about it? And so when we talk about putting together this Retire Smart roadmap, I think every single retirement plan really needs to have a couple of different components that you need to be crystal clear on before you get to retirement. Okay, number one, how are you going to collect your Social Security benefits? That's very important. Number two, how much risk is your portfolio subjected to? What if we go through another year like 2008, or if we go through another dot-com bubble? Are you subjected to 30, 40, 50% decline in your portfolio? You got to understand some of these different things before you get to retirement. If you're not prepared, then that could be just a disaster waiting to happen.
You know, Spike, sorry, I'm really surprised the people that come in to see us, how little they know about what they own in their portfolios, right? And when we talk about a 60-40 split being down over 20% year to date, they go, why is that happening? I thought diversification was the name of the game. But when we run a risk assessment for our clients, it's very startling to them to know how much risk is really in their portfolio. And we like to make it as clear as possible.
And when you say that kind of surprise, are you talking about for people who are still working and close to retirement, or people who are already retired and they're surprised what they own?
I think it's both. I mean, when you're working, obviously you have time. That's the one thing we can't make up, right, is time. But there are people that we see come into the office and they're either ready to retire or retiring in the next couple months, and they've never adjusted their allocation. They've been investing that passive investment that their employer provides for them for the last 20, 30 years.
I'm going to be honest. So I just recently put together a 401k, and we were offered 20-some different funds, and I'm supposed to turn the dial of how much percentage is supposed to be. I've got to tell you, I'm in and around the industry, and I don't know exactly how to put together a 60-40. So if the 60-40 is the middle baseline relatively safe, I have a feeling that a lot of Americans out there probably aren't as safe even as a 60-40.
Yeah.
Yeah, and it's really interesting because we talk so much, the industry, the financial industry, talks so much about diversification, right? Have your money in different places, and that's supposed to help you mitigate risk. When we think about diversification, we don't think about it in terms of stocks versus bonds. When you come into our office, another part of this Retire Smart roadmap is something that we would call a 3-bucket analysis. So when we look at someone's 401k, Nick, myself, our partner Ozzy, our advisors, we don't see one account that has $1 million in it. What we see is how many different buckets of money can we spread that $1 million out over to make sure that you have some money that's totally safe and secure that you cannot lose. You have some money that's meant for the next 1 to 3 years, very, very low risk. And then you have your inflation protection money, which maybe has a little bit more risk associated with it that can grow over time. Okay, so this is what we do with folks every single day in our office. And what I'd like to do is, why don't we open up our phone lines? We do this every week.
Yeah.
If you call into the show, it's 833-308-5200. You can get your own Retire Smart roadmap. It's totally complimentary. There's no obligation. That phone number is 833-308-5200. If you can call us, you can schedule that visit with Nick, myself, and our team to go through your Social Security analysis, go through your retirement portfolio analysis, tax analysis, and customized lifetime income plan, which will help you understand how prepared you are to deal with market volatility as you head into retirement. So if you're serious about that, pick up the phone, give us a call, 833-308-5200. We also have a QR code here, so you can pull out your cell phone, take a picture of the QR code, and schedule your visit with us right away.
Prashant, Nick, we're going to continue talking about market volatility when we get back. We're talking a lot about the stock market. I want to talk a little bit more about the bond market side of it and why this has been one of the worst bond markets in nearly 5 decades. Folks, as Prashant was just saying, give us a call right here so you can start your own Retire Smart roadmap, 833-308-5200, or open your phone right now, go to the photos, point it at the screen down at that QR code, click on that. It will take you right to their scheduling device so you can start your own complimentary 60-minute meeting with Prashant, Nick, Ozzy, and the team here at Retire Smart Maryland. More right after this break.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
Welcome back to Retire Smart Maryland, brought to you by Elite Income Advisors. I'm your host, Spike Spengel, here with Prashant, Sabapathi, Nick Innerbichler. Fellas, we were talking about the stock market volatility of what's going on right now, but that's not the only volatility that's hitting Americans today. It's also the bond market. Nick, tell us a little bit about what's going on there. Why is the bond market so bad?
So fundamentally, stocks go up, bonds go down, and vice versa. The problem with right now is that we are ending a 40-year bull market in bonds. Interest rates started to decline in the late 70s and were low until recently. And the Fed has raised rates several times this year, and that's impacting the longer-term bonds especially. Long-term treasuries are down over 20% year to date. There's nowhere to hide, right? So when stocks go down and bonds go down at the same time, it's an impact to our portfolios.
I think that's a really good point, because we think back to 2008, and it used to be, hey, if everything in the stock market was going down, we could just shift some of that money over to the bond market. We might have lost a little bit, but we would have been relatively protected versus stocks. But like Nick's talking about now, as interest rates go up, bond values come down. That's just economics, kind of, you know, basic economics there. And if you can't move your money from stocks to bonds because bonds are down 20% or 25%, where do we go?
Are Americans getting that message? Are people hearing this enough that the bond market is down just as much? Because they're well aware of what's going on with the Dow Jones. You turn on your television screen, you see those numbers, those red numbers at the bottom of the screen. So people go, well, let's move over to bonds. And they're taking just as hard a losses over there.
Well, I'd like to just say I was meeting with one of our viewers. They came into the office, tried to take them through the Retire Smart roadmap process. And one of the concerns that they shared with me is they said, I'm in one of these target date funds that is one of these funds that it was like a 2020 fund. And you would think if a 2020 fund, and now we're in 2022, that's supposed to be a pretty conservative fund. They told me I've lost over $200,000 in this one fund this year. And I thought that we were being conservative. Is that an issue?
Yeah, I'm sorry. It's always an issue for me. Because the target date fund is always explained as kind of an easy way. Here, just pick the year that you're going to retire, and the funds will do everything for it. Nick, will you explain a little bit how the target date fund works for folks?
Yeah, so when I first started in the business, they called it set it and forget it.
Yeah.
And unfortunately, that's a bad strategy to have right now. So as you get closer to that retirement date, so let's use 2020 as an example. That's 2 years ago. So if you get closer, as you get closer to that target date of 2020, your portfolio is supposed to reallocate more into bonds. So right now you might have 60% bonds, 40% stocks, complete opposite of what we were talking about earlier in the show. So if you have 60% in bonds and a long-term treasury fund is down 20+%, a 2020 fund is down over 20% year to date. Prashant used the analogy, $200,000. If that's $1 million portfolio, you're down $200,000 and you're already retired theoretically. That's harmful.
So my first question is, what can somebody do? If they're in a target date fund, or if they're not sure exactly what their allocation is, they're still working. They're a couple of years away from retirement, maybe 5 years from retirement. But they don't really have somebody actively managing their fund. They don't have anybody with hands on the steering wheel.
Right.
What are they supposed to do? Are they able to call somebody like you? Because you're not the one managing that money in their retirement accounts.
Yeah, so I think where you got to go with this is you have to have what I would call, we call it, in our office, we call it green bucket money, right? So green bucket money is money that is totally safe and secure, can't lose a single penny of it. And then we have red bucket money, but within that red bucket, there's an alternate way to do things that's kind of counter to what we've always been taught, right? We've been taught, put your money in the 401k, and if the market goes up, you'll do well. But when the market goes down, you just keep putting it in. But when you're 4 or 5 years away from retirement, you can't afford to take a 25 or 30 or 50% loss. And so that's where we get into this idea of passively managing money versus actively managing money. I know you were just explaining this to a client. They said, I heard you talk about active versus passive. Can you just briefly go through the difference between the two there?
Sure. Passive investment management is basically what you do in your 401k, right? Your employer says these are the 10 or 15 or 20 funds that you have access to. You put your money in every 2 weeks or whenever you get paid, and the money grows over time. That's fine while the market's going up. But as Prashant said, the closer you get to that retirement date, 4 or 5 years out, if we have an event like we're experiencing now or another 2008, that's not a good way of managing your money, because when the market goes up, we're all happy, but when it goes down, it can impact your retirement. Active management is much different. Your investments change as time changes, right? So you're not always invested in the same things. It's not so much asset allocation, but it's moving your money in and out of things that are going to be positive when the market's positive, but protect you more on the downside when market conditions change.
Now, this sounds like it's something that you have a great interest in. Is this something that you do completely in-house? Do you have other folks who help you with it? How do you do the asset management inside the firm?
Look, what Nick and I are really good at is we're really good planners, okay? But when it comes to managing money, we delegate the best money managers in the world to do this kind of work for our clients, okay? And so we outsource these services to other firms that are absolutely excellent at it. And so that's what you get when you come in to visit with us. But before you even make any changes like that, you got to figure out where you stand today. I don't think that you can go where you want to go without understanding where you stand today. And so, you know, let's open up the phone lines again. It's 833-308-5200. If you're concerned that your conservative portfolio has gone down by 15 or 20%, and that is not in line with what your expectations were, this is your opportunity to pick up the phone and give us a call. When you come in to visit with us, you leave your checkbook at home, folks. It's completely complimentary. You'll meet with Nick, myself, and our team, and we'll take you through our process to get you on track to putting that Retire Smart roadmap together. It's going to include a portfolio stress test to show you kind of what your worst case scenario is. We'll go through a custom tailored income for life plan to show you where your income's going to come from in retirement. And we'll even take you through a tax analysis to see if there's any opportunity to reduce your tax burden in retirement. But it all starts with that phone call. It's 833-308-5200. Call now.
We're going to have to take a very short break right now, but as Prashant just said, call the phone number you see right here. As you can imagine, their schedule is going to fill up quickly, so try to call as soon as you can. We don't know exactly when the markets are going to come back. We don't know when the bond markets are going to come back, but you need to make sure that your money is going to last all the way through retirement. Call as soon as you can, or use the QR code on the bottom of the screen. Open your phone up to your camera, point on it, and when the camera comes up on there, click on that. It'll take you directly, and you can schedule a meeting right away. Or call the phone number you see right here, 833-308-5200. Are you wondering what you can do about those retirement accounts at work? We're going to talk about an in-service withdrawal when we come back right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to Retire Smart Maryland with Prashant Sabapathi and Nick Innerbichler. I'm your host, Spike Spengel, and we're talking about the market volatility and, more importantly, what you can do as a retiree and a pre-retiree with these markets. I did mention right before the break, this is something you and I were talking about while we were sipping a coffee. What exactly is the in-service withdrawal? Can you explain that to folks?
So quite a few years back, there was a large event where a certain company went out of business, and the people lost overnight their wealth and their retirement plan. So at 59 and a half, at 59 and a half, there's something called an in-service. Now, not every company allows this, but most companies, including the federal government, which just down the street from our office, there's a huge government presence. A 59 and a half in-service rollover means that while you're working, you can access those underperforming funds from your retirement plan and roll them into a traditional IRA that you can now control and invest however you want. It's a great strategy. It helps people position their assets for the long term.
So 59 and a half.
Yep.
I can take the funds out. I can manage them how I want to. But what if I know that I'm not the person who should be managing them? Then what do I do with that? So I put it into an IRA, so it's still tax protected. I'm not writing myself a check, right? Then what? Then what do I do from there?
So then it's about creating that plan for how many different buckets of money you want that rollover to go into, right? So instead of just having 10 different options through your employer, you know, we have so many people with the federal government that have the thrift savings plan. You can roll it over into a combination of IRAs. Maybe one IRA is completely protected from the market. Maybe you have some in low risk, some in more intermediate term and risk investments. But I think we actually have this graphic because when we talk about safe and secure investments, one of the good benefits, I think, about rates going up is that while you might go to the bank and not find that your savings rates are going up, there's shorter term accounts out there that rates have really been going up on. You know,
Randy, I believe if we go to our producer, Randy, I believe we have a graphic on this. And so what you are talking about is something called a MYGA, right? So multi-year guaranteed annuity. Very, very similar to what our bank CD was like. The kind of stuff that my grandma and grandpa used to buy 30 or 40 years ago.
Yeah. And what we've been seeing a lot of is, I just did this with a client last week, is, you know, we are having a little annual review, and she said, I have $100,000 just sitting in my savings account. It's not earning anything. So what options do we kind of have that are out there? And we looked at one of these MYGAs out there. You can get anywhere from, you know, 3 to 4% per year on a relatively short term. And
if I look at that 2 to 3 year, I mean, that's what a bank CD was.
Exactly.
You put it in for a year or 2 or 3, and you were going to earn, you know, a minimum amount. Because as we were saying before, right now in the markets, nowhere to run to, nowhere to hide.
I think there was a song about that.
Yes, indeed. So with stocks down, bonds down, but what we were also talking about is that interest rates are going up. It's getting more expensive to borrow money. But why aren't I seeing those interest rates in bank CDs down at my local bank? Why aren't we getting those interest rates available to us in safe money?
Well, I would say that the big banks don't have to give us those rates. So you're going to see them on a more boutique type of bank, a little neighborhood type of bank. But the bigger insurance companies have the ability, they have the leverage, and that's what they're in the business of doing, is providing good fixed rates for our clients. So, you know, they're going to lag a little bit behind the interest rate increase. I think everybody expects interest rates go up, mortgage rates go up, bank savings rates go up. Not so fast.
Yeah, and so this is why you have to look at the alternatives that are out there. But look, when we put this information out there. You know, the MYGA and everything, it's a good tool, but that's exactly what it is. It's nothing
It's like
more than
one
a tool.
of the tools in the box.
Exactly. So, you know, if you're calling us just for the MYGA, we can help you out, but really it's about the bigger picture here, which is having that roadmap in place, right? I always say you have to have the roadmap in place before you go on your travels, right?
Because I also want to be clear. You're both not saying to completely get out of the markets.
Correct.
I mean, you're not saying, hey, this is a play, let's all move over to cash.
Correct.
Because that's also timing the market.
Yeah, and we know that that's an impossible thing to do, is exactly precisely time the market. It comes back to being prepared, okay? Like, it's too late to get a roadmap in place if you're already lost, right? And so why not do that ahead of time? And that's what it's really all about, is when you come in to visit with us, we're gonna help you go through the 5 different steps of creating Social Security plan, income plan, risk analysis, income analysis, and legacy transfer. We go through these 5 steps, and maybe a MYGA is a good part of the process to be a useful tool in helping you retire the way that you want to. So that's really what it's all about, folks. Phone number is 833-308-5200. The one thing you cannot go into retirement without is confidence. Confidence to know that you're going to be able to deal with inflation, to deal with a volatile market, to deal with the threat of increasing taxes and also interest rates. So, you know, give us a call right now. Put together your complimentary, no obligation Retire Smart roadmap and make sure that we get on track to retiring the way that you want.
Nick, I know that you pay a lot of attention to the market volatility. We are going to have to wrap up today's program, but what would you like to say to folks who are really nervous right now? Is it too late? Can they just pick up the phone? Is it okay to have a conversation, even if they're not sure what they're going to do next, just to be able to sit and talk with a professional?
Prashant and I are educators at the end of the day, right? It's never too late. We're always here to help. But the sooner you pick up the phone, the quicker we can sit down and analyze what's going on with your personal situation. We can make adjustments along the way to your roadmap, but having that plan in place is the most important thing.
Right. Well, Prashant, as you were saying, the Retire Smart roadmap, we're about to wrap up today's program. Tell people exactly what they're going to do when they call that phone number here before we leave today.
So when you call into the phone number, you'll be able to schedule a visit with Nick, myself, and our team at Elite Income Advisors, and we'll help you coordinate your Social Security benefits. We'll put together a custom-tailored Income for Life plan. We'll do a stress test of your retirement portfolio, and we'll take you through taxes and legacy planning to try to minimize your tax liability as you head into your retirement. So don't miss out. Pick up the phone and give us a call.
Thank you so much for watching Retire Smart Maryland. We will be back again next week. Call with your retirement planning questions.